action in the oil space. And now our energy segment brought to you by the India Energy Week. Oil prices have now crossed $81 a barrel, the highest in 4 months, thanks to wider US sanctions on Russian oil and the expected effect on exports to top buyers, India and China. But all of this may not be bad news for India, so hold on to find out why. Brent crude futures rose almost $1.7 to $81.44 a barrel on Monday morning after hitting the highest level since August 27th at about $81.49. So crude oil prices have risen almost 7% since January 8th after new US sanctions on Russian oil, which affects 2 oil producers and some 183 ships. Goldman Sachs had estimated that these ships represented some 25% of Russian oil exports. That estimate is a little higher by some other brokerages. India is, however, not expecting any disruption to Russian oil supply in the next 2 months as US sanctioned tankers are allowed to discharge crude until March, a senior government official told Reuters on Monday. Now, the big expectation or the flip to this story, of course, is that India might actually start getting discounted crude. Sources told Reuters that Russia could offer deeper discounts for crude exports to India to meet the $60 a barrel cap to continue exports. That cap was imposed by the G7 countries in 2022 to curb Russian oil revenue used to fund the Ukraine war. Meanwhile, Bloomberg reported that 3 tankers carrying more than 2 million barrels of Russian oil were floating in waters off the eastern coast of China after they were sanctioned. So what is driving up oil prices right now, and what are the overall demand and supply trends looking like as we go into 2025? I reached out to Viktor Katona, head of oil analysis at energy research firm Kepler, now based out of Dubai, and I began by asking him why prices were rising so suddenly now before asking him about his outlook.
Well, it's definitely geopolitical risk premiums all over the place, because one could assume that when the Biden administration would leave the Oval Office, they would try to leave the Oval Office with the oil prices, going lower. Because ultimately, the supply and demand fundamentals are quite negative. But effectively, the Biden administration has started its tenure in 2021 with the oil price of 56. And it's finishing it up. I mean, we don't even know where it's going to end. It's going to be above 80, that's for sure. And initially, it all started out with Iranian sanctions and a little bit of a tightening on that end. And right now, it's a fully blown Russian story. The sanctions on Russia are by far the biggest that we have seen so far. The market is abuzz with speculation as to what might be potentially happening. And effectively, all of that just feeds into the insecurity. So it's a really interesting interplay between a very weak fundamental picture and a lot of geopolitical risk premium.
Right. And I'll come back to that risk premium in a moment. But from a pure demand and supply point of view of oil, where are we today, particularly as we stand in the second week of January?
Well, we stand in an environment where we look into 2025 and we know a couple of things. We know that we will have a tremendous amount of non-OPEC supply hitting the markets at different stages in 2025. So the market is going to be oversupplied, which will most probably force OPEC Plus to maintain the production levels that they have currently pretty much across the year. So we know that the market is going to be oversupplied, and we also know that demand is slowing down. Basically, the extent of demand slowing down is also a little bit of a reflection on how aggressive Trump could be, because it could be much worse. Right now, we've had a relatively meager, sort of lukewarm Biden attitude towards China. And even with this, China has slowed down to the extent that it basically almost doesn't have growth in diesel and gasoline. So it's basically the Chinese growth story is over. Maybe the Indian growth story could be something of a bullish momentum for oil price. But beyond that, there's nothing. We have stagnating Europe, stagnating North America. Africa could be a good story, but it always has its difficulties in growing the way that it should. So ultimately, demand growth will be below 1 million barrels per day. And pretty much this is a new reality. We are slowing down as humanity with our oil consumption. So again, demand outlook, because of this, there's more crude hitting the market. We actually need less crude into 2025, will be increasingly bearish for most of the year.
Right. And to come to the geopolitical part, the latest trigger, of course, is the increased US sanctions on Russia, which is resulting in over 180 ships being sanctioned and 2 producers as well, which in turn is affecting or likely to affect both India and China and their imports or our imports. So why is this pushing up prices to start with?
I mean, it creates a huge layer of uncertainty whether the Russians can actually continue the exports that they have currently. I think that the exports that we see currently will be maintained, but it will come at several caveats. Freight will become significantly more expensive. Because the sanctions pressure, the Indian buyers, so the Chinese buyers, would ask for much better prices than they had in 2024. So basically, the discounts on Russian oil will effectively deepen. Everyone will be asking, don't give us -3 to Brent, give us -5 or give us -6. The classical game. And effectively, people and trading operations would get much, much more creative. Basically, you've seen it in late 2024. Almost every single cargo just, went from port A into the destination port B. There was no hidden operations, ship-to-ship transfers. I think we're going to see a huge recovery in everything that's hidden and wants to be hidden. Ship-to-ship operations, shutting off transponders, spoofing your signals, all of that, beautiful interplay between the sellers and the buyers and whoever the oversight is, that is going to come back again. I'm not a firm believer in this having a big impact on supply and demand balances, but it will definitely create a lot of speculation. And speculation is great for oil prices. I mean, of course, if you want them to be higher.
Okay, so for India and China, you said that both countries could be in a position to get oil at lower prices. So, in which case, it helps these countries because their overall oil import bill will come down. And particularly, let's say, at a time when the dollar itself is so strong, that's useful. So, I mean, which sort of comes back to the same question, which is that do you see India and China being able to command at least, let's say in India's case, more than 25% of imports at a lower price than what it was last year?
And particularly, and a very emphatic yes, considering how little have prices changed in 2024. I mean, you just look at prices of Urals. It was, Brent -$3 per barrel pretty much across the entire year. There was almost little to no change throughout the months, regardless of the seasonality. And I think now the Indian refiners finally have, a great argument to say, hey, look, dear Russian supplier, we would be potentially even keen to buy it, provided that your tanker is non-sanctioned. But you need to offer us a great price. And then ultimately, the boot is finally on the foot of the Indian buyer. They can demand a much better price, and they will. So I think it will happen. 25%, easy. Considering Russian imports have made up 45% of all of India's total seaborne imports, I think we could even be talking about much higher figures than that.
Right. And as we go into, 2025 and into February and March, if let's say demand starts slowing down, particularly for heating and so on, are there any other trends you're seeing?
Well, there's this big seasonality trend, not in India, but say in Russia or the suppliers. And particularly this moves into March and April, when you would have the first spring refinery maintenance period. India doesn't really work under the same logic that, say, the Russians or the Europeans would, because in India, mostly the refinery maintenance takes place in the monsoon period. So there's nothing happening in the spring. Spring is still a solid consumption period, not booming, but it's basically stable growth from one month into another. This means that there will be a lot of crude into a period when India needs it, but the other continents, so be that, Russia, the former Soviet Union, Europe, even North America, no longer need that much crude, which again is great because you would be awash with crude. India is still consuming. India is still a keen buyer. So effectively, I think everything is set for a much better period into the spring than the winter was, when India was buying expensive grades for quite a lot of money and couldn't really dictate its own terms. I think India could dictate its terms very soon as pretty much the key buyer.
Right, Victor, thank you so much for joining me.